Hello and welcome to our virtual fireside chat on the fundamental review of the trading book. My name is Jessica Watson and I'm pleased to introduce our special guest, Yi Zhao, Senior Manager in EY's Actuarial Services. Yi has led numerous interest rate risk in the banking book, market risk and liquidity reviews, audits and validations for Australian financial institutions. Yi also spent 2 years in London assisting a global bank develop and implement their FRTB model and system, leading the risk and capital workstream. And Martijn Groot, VP of Marketing and Strategy at Asset Control. Martijn oversees and steers Asset Control strategy for corporate development, innovation, and communications. Martijn is a published author with extensive knowledge of financial and risk data management. Welcome, Yi and Martijn. Kicking us off today, we will discuss the shift in FRTB timelines. How do each of you see banks preparing themselves now for FRTB?
I think it's a really busy time at the moment. With COVID-19, timelines have been shifted a little bit, particularly in some jurisdictions, but there's still quite a lot to do, and the banks have already invested a huge amount of time on FRTB. I think in particular, budgets are quite tight at the moment, so I think they're all really thinking about how they can efficiently use their money and resources at a time like this.
Yeah, I would say indeed, I think the next 12 months are critical for banks in keeping to those sort of delayed timelines. I think with these sort of Basel type regulation, it always takes time to land. There's always a lot of sort of lobbying and tuning and quantitative impact studies. In this case, there was, of course, an additional delay due to COVID-19. I think generally what we have seen is this sort of continued intensity of the use of market data, right, in risk and finance processes primarily. And certainly a lot of firms struggle with effective sourcing, quality management and provisioning of the required depth and length and the increased granularity of market data that is needed. The sort of longer histories, the additional scenarios and the eligibility tests are all examples of that. I think this data intensity is in every part of a bank's business, but definitely impacts the functions that are sort of the most enterprise level by definition, like risk and finance.
Yeah, I think with all those delays and with all the regulatory uncertainty as well in the region, a lot of the clients that I've been talking to, they're all focusing on the no regret spending, and that's really that data management and IT component that's really key. They're all really focusing on building up those time series because they know that no matter what, that's always an improvement on their VAR as well as their IMA-ES as well in the longer run.
Yeah, I think that's right. I think the other thing that we have seen, I think also as a result of COVID-19, is I think an acceleration of the shift to the cloud. It's of course something that was going on already. I think with sort of increased attention to resilient infrastructures and let's say more sort of scattered use of the data, we see a lot of projects linked to FRTB and FRTB also acting as a catalyst to take a sort of more wholesale look at the data infrastructure. And of course, that requires sort of state-of-the-art scalable tech, and in some cases also managed data services to supply the required data, not only for FRTB but also in other functions that need accurate market data.
Yeah, I mean, I think it makes absolute sense to use the cloud in this case. You have your stress period selection runs, which will be not very frequent, but require a huge amount of calculation over a relatively short period of time. It's absolutely key to delivering FRTB in a usable fashion that the business can actually gain insights to.
Thank you both. Moving to our next question, what do each of you see as the main data management issues banks face in meeting the FRTB requirements?
If I can start with that. So we started live as a financial data feed integrator and time series data warehouse, and that's still a large part of what we do. I think FRTB brings new data requirements, new data sourcing requirements, the historical data length, new sort of data quality requirements, in some case building on a bit from the BCBS 239 principles from some years ago. And of course for the IMA banks, the modelability assessment that needs to be done. This can mean sort of the use of new data sources. Right? Banks can, of course, use their own internal trade data from their trading system to gauge modelability. But in many cases, we'll look to supplement that with data from any of the commercial data providers, the enterprise data providers, broker feeds, or sort of publicly available post-trade data due to reporting requirements earlier on. So we see that sort of data aggregation for the trade level data as sort of a new data management requirements. We work with all of those providers of trade level data sets to help banks build the sort of most accurate picture of market activity. But I think we also had to evolve the proposition to from pure financial data management to also include sort of more analytical capabilities. And that could include, for example, the right use of proxy rules. So to complete today's sort of pricing, but also to plug any gaps in the historical record. And those rules, for example, need to be reviewed periodically. Right? That there is a sort of periodic reassessment of whether they're still valid. And there's also a lot of other, I'll say, data quality aspects on the whole risk factor preparation, from sourcing, from sort of inconsistencies, plausibility checks, to that sort of completion of the history via the backfilling rules.
Yeah, I think totally agree with you, Martin. I think, a couple of points that I think you raised are really key there. Some of the clients I've been working with, they have really global systems and businesses, but that also comes with a huge amount of challenges with, multiple time zones and inconsistent data across, all those different businesses, be quite federated. And so, having a consistent time series across all those businesses is not only important from a PLA perspective to make things easier there, but also through your IMAES capital charge. If you have inconsistent data, rates, FX across different businesses, then you can potentially have some additional capital charge simply because the models aren't fully offsetting correctly. I think the other part that you touched on is just all the new sources of data and metadata really that you'll need to produce your liquidity horizons or your standardized charge. Even something as simple as categorizing your large caps and small caps for your IMAES. That's something that can change quite frequently, but it's more of a data attribute or metadata component that's coming in. So that's quite a different data source that most banks normally wouldn't pull in.
Yeah, I think that's very true. I think the potential ramifications of inconsistencies have gone up quite a bit. Right? And when sort of the data usage is less, the data intensity is less, it is, let's say, easier maybe to iron out any wrinkles, any differences, or to do reconciliation. But when you need more, sort of much more volumes and much more historical data, and when the sort of impacts of failing backtesting are larger, it's all the more important to have a sort of streamlined process in data supply.
And I think also probably just touching on our previous comment around, costs and timeline, if you don't get this right, there's really actually not much time left to meet both the standardized deadlines, reporting deadlines, as well as IMAES. We need quite a long runway in this case to prepare our regulatory submission, to do all the PLA and backtesting results ahead of, whichever regulatory date that you're working to across the region.
What would be a few priorities in terms of use cases to address?
So we've seen FRTB as the catalyst to improve data management capabilities. Certainly often was a contributing factor in upgrading the overall infrastructure. Like due to the sort of rises in volume and the increased sort of granularity of market data usage in risk finance and other functions, very often sort of current infrastructure was creaking at the seams in trying to meet with these requirements. So we spoke about a shift to the cloud, shift sort of to more sort of scalable market data management technology. Certainly firms often still had quite separate market data management processes in risk and finance and sort of the business silos. What FRTB imposes is that sort of bigger consistency between front and middle office. Also additional demands on the metadata that also he talked about. So I'm talking about permissioning, certainly usage tracking, and overall the sort of explainability of data points, the ability to justify sort of how you came to certain decisions, how you came to certain values. So for that, you need data lineage. You need to be able to sort of track and trace data as it flows through your organization, and also being able to point back to the original sources that you got the data from in the first place. Then, of course, there are the sort of actual sort of content requirements on the trade level data sets for modelability, historical length, the different scenarios. I think all these requirements are hard, if not impossible, to live up to if you have a sort of scattered infrastructure with multiple data silos.
Yeah, and I think, absolutely. I think in particularly for me, the process for validating all your rates and other market inputs and aligning them front to back is absolutely key. Even if you're, not planning to go IMA, even for standardized purposes, it's something that can be of huge value to a business where you have, alignment front to back, and also, using those rates for all your other models across the bank, whether it's for your credit risk exposures, for your interest rate risk in the banking book. The alignment front to back is really key there. And so we really do see a lot of value in uplifting those processes. At the same time, we've seen, a huge amount of market volatility lately. So some of those thresholds that we've previously seen for, be it interest rates or volatilities, some of those thresholds are really no longer relevant. The Australian dollar has moved quite a lot, and Australian interest rates are now at record lows. So what that means is those existing IPV processes really need to be uplifted for this new market. I think the other component that banks should really look at the moment are really standardized tools and calculators to really speed up some of their processes. So, there's a number of vendors already at the moment who are developing these tools that really, I don't see a huge amount of point in having an army of your own people developing these tools when they are already available off the shelf. I know ISDA's been doing some benchmarking on standardized calculators, and then there's been a number of vendors that have been approved by ISDA through that benchmarking process.
It's interesting what you mentioned here about the market volatility from earlier this year. I think certainly if you have a sort of fairly, let's say, a basic or simple quality management process, operations departments can be overwhelmed, right, just because of the market movements that we have seen this year. So I think for that you need, smart plausibility checks that take the general overall market movements into account, and that can zoom in on the real outline data quality issues. So I think by and large, what we have seen in FRTB as well as other regulatory initiatives that cut across the silos is that very often the cost of change is very high, right? Because there is not a data model in use like the ISDA classification. So in our view, data services is the next level after, say, cloud storage, cloud computing, should also be a common resource that can be accessed from different functions, that is consistent, where you have the right metadata, so you know to what extent you can use the data for your specific use case. I think that would lead to a lower cost of change, really increased user enablement as well.
Yeah, I think, FRTB is obviously a major change, but, we have to keep in mind future regulatory changes as well, even if it's, a small change to IMA parameters or a larger change or the next FRTB in 10, 20 years. So I think the banks certainly have a lot to do over the next 12 months.
I think that's very true. I think FRTB, like any regulation, it's I think not so much the question of being able to produce a specific report, but rather the overall capability of slicing and dicing your data and essentially knowing what you're doing, right?
Yep, absolutely.
and being able to explain that and documenting that and tracing that.
Yeah, I think that's a good point. Like, I think probably about 2-3 years ago when I was speaking to clients, they were really thinking about minimum viable product. And, we've been always yelling, this is the opportunity to deliver something that the business can actually use to actually better manage and monitor your risk, and also, help not just be a regulatory tool, but think about, how your business is actually capital and help decision making on where you should be investing.
Wonderful. Well, thank you both very much for joining me here today and sharing your insights on the fundamental review of the trading book. For those listening, if you have any questions about today's discussion, please get in touch at info@asset-control.com. Thank you and goodbye.
Thank you very much.
Thank you very much. Bye.